This is the current federal tax developments for the week of May the 11th, 2020. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. This week we're going to look at a number of issues, some of which comes from the payroll protection program loans. Others come from the employee retention credit, became a big thing this week. And we're also going to look at some actual just straight up tax developments this week, something for a change. So we'll take a look at what's happening. We'll start with our first issue this week. And the first issue that we're going to have is going to be a release from the IRS on their website, COVID-19 related employee retention credits amount of allowable qualified health plan expenses, FAQs. This related to a bit of a dispute that opened up during the week between the IRS and 3 tax writing committee members, the 2 chairs, and the ranking member of the Senate Finance Committee. The IRS had ruled on their frequently asked questions that if an employer only paid health care costs for employees that had been furloughed, that the business could not get the employee retention credit. For those who don't remember, the employee retention credit is the credit you get assuming you do not get a PPP loan. That's one of your caveats there. You pay for employees. Now, either you're in a complete or partial shutdown ordered by a government to have that happen. You then had to either have that or you had to have a substantial decrease in revenue. And in that case, that's when your revenue drops by more than 50% from what it was the same period a year before. And then that continues on until the first quarter after your quarterly income or your quarterly revenue has risen back to 80% of what it was the prior year. And all of this ends the end of 2020. So basically, it would go through that particular time period if you had the drop in revenue. Otherwise, it's for the shutdown time. If you had 100 or fewer employees, the credit applies to all employees you pay, while if you have more than 100 employees, the credit is only for employees who are not currently providing services. This particular issue mainly affects those businesses that are the above 100, and this would affect employees who are generally not providing services, but the employer has decided that they would like to continue to offer the medical coverage. And the IRS had ruled that, well, the way the law was written in the IRS's views, it said the health care costs only counted to the extent they were related to wages that were paid by the employer. And if you paid virtually any wages, you could then pay the health care costs. But if all you paid was a health care cost and the employees had been furloughed and probably are collecting unemployment, then you couldn't get the credit. A letter went out this week from the chair of the Senate Finance Committee, Chairman Chuck Grassley of Iowa, the chair of the Ways and Means Committee, Representative Richard Neal of Massachusetts, and the ranking member of the Senate Finance Committee, Senator Ron Wyden of Oregon. The 3 of them said that, in fact, this particular situation was not what the Congress intended. That Congress felt it was important for people to maintain their health care coverage. They said, especially in light of the current situation on the medical front, that it was not something they wanted to encourage to have people drop coverage. So they meant for it to be subsidized even if the employer paid nothing else. In this particular case, we're going to discover another case where this is not going to work as well for these 3, or at least apparently hasn't yet. The IRS reversed course. The IRS now says that they will allow the credit in that particular case. So if you have a client or your business is paying for the health care coverage for the employees who have been furloughed, and you're under a partial or complete shutdown, and the IRS's FAQ does have a lot of good information about what qualifies as a partial shutdown, what doesn't qualify, and those issues, so you can go find that out there. But if you're under that complete or partial shutdown, or you have the decrease in revenue period, then you now can claim the credit for paying the health care coverage for half of what you pay for the health care coverage for the employees who are, otherwise furloughed. So, yeah, that's kind of useful in some cases if you're affected by that. At least you know now that the IRS has changed its mind and they are going to allow you to go ahead and claim that credit. Next up, we have more FAQs from the IRS. This, or actually from Small Business Administration this time. This is and this just keeps changing all the time, the Payroll Protection Program loans frequently asked questions. The Small Business Administration has made many, many additions to these facts over time. This particular one, though, was a issue related to the problem or the issue that arose that all started with the story, the Ruth Chris and the Shake Shack and the Potbellies getting when they obtained PPP loans, and there was the uproar, and the questions came from SBA or from Treasury and from Senator Rubio about whether or not those companies had correctly certified that the loan was necessary for their continued operation, and with the obvious implication that they had given false information on an application to obtain credit. And that's kind of a big thing because we're talking about, in those cases, in theory, assuming you get a prosecutor who could make it stick, which may be difficult because of how vague it was worded, but let's just leave it there. Because of that risk, you might want to back off, and SBA had said, well, if you return the money by May 7th, then we will not pay any real attention as to whether or not your certification was made in good faith. Otherwise saying that if you just turn it in, we'll just pretend you never did it. Well, here's the catch, of course. One of the things you give up when you get a Payroll Protection Program loan is the employee retention credit. Now the question arose, these companies that are giving back the money, the employee retention credit is lost if you get a PPP loan. It does not matter if any of it is ever forgiven. The forgiveness only matters on the side of the deferral of the employer FICA. But in this case, it doesn't matter. You get the loan, you lose it. The question that was being asked was, are these companies, because they did get a loan, are they going to be deemed to have gotten the loan even though they returned all the money? Because as you might say, paying back a loan is what we usually do with a loan eventually. So the theory being, well, it's not that different. They decided that, in fact, kind of to offer an olive branch of sorts. The IRS had indicated that businesses that returned their funds by that May 7th date would be eligible for and be able to claim the employee retention credit. So we're just going to pretend you never actually took the loan. We're just going to ignore it. Just don't worry about it. Never was there. We're good. Well, the problem was the IRS issued that, on what would be the 5th of May, but at the same time, the Small Business Administration had just posted another update that extended the date to return the funds to May 14th. So the obvious question arose. If we return it after May 7th but before May 14th, now do we get the employee retention credit? And the SBA the next day confirmed that you would get the employee retention credit. Now that's interesting that they gave the first confirmation because obviously they're not the agency that decides if you get the credit. But the good news is the IRS also agreed, and now the IRS website that started out telling us that you couldn't get this loan, that you would be able to return by the 7th, now says return by the 14th and you're fine. So bottom line, this does open up something for everybody you need to be aware of. Any client who has gotten a PPP loan, and assuming you're listening to this before May 14th, and let's say they've discovered that they're going to have trouble getting employees to come back, they don't want to go the route of turning in the employees for unemployment fraud. That could be a negative sort of employee relations problem over time if you got a reputation for doing that, shall we say. So you might decide you don't want to do that, but it looks like you will not be able to get the vast majority of the loan forgiven. You won't be able to keep a bunch of it. You won't have enough to really even pay the rent with what's left over because there's only a couple of employees who are here. So bottom line, you might want to say, I'm just going to give that up. The employee retention credit will be better for me. I'll leave the employees on unemployment. So, they're happier there. They're being paid more there. I'll go ahead and I'll pay this back. And when we start up the business again, then we'll go and get the employee retention credit. Because the advantage for the ERC is it is something unlike the PPP loan that you get it right now, and I don't care if you're ready to restart. I don't care if you're reopened, you're allowed to reopen. It doesn't matter. You've got to spend it within the 8 weeks. The ERC, especially for an employer of 100 or fewer employees, really only starts to come into its own when you open back up. If you have 100 or fewer employees, remember, we get the credit for every employee, not just the ones performing no services. So that means we could use the ERC as a way to partially subsidize our restart. And if I'm not going to get any benefit from the PPP loan or get a minor benefit from it, I might be better off going this route. So those clients have until May 14th to decide to return the funds. So if you have somebody in that realm, you might want to, who has that problem and is struggling with that issue right now, you might go ahead and say, maybe you could consider returning the funds by the 14th. And if you do so, then we can get the employee retention credit so that when you do restart up, we're fine. And if your employees all think it's okay to be on unemployment, they're happy with that, then, you might not be, except for not getting some money to pay your rent, which obviously is not a real good thing. But aside from that, you may be in better shape over time by using the employee retention credit. As I said, did we keep getting new stuff from the SBA? This was a new set of interim final rules, RIN 3245-AH40, entitled Business Loan Program Temporary Changes, Paycheck Protection Program, Non-Discrimination and Additional Eligibility Criteria from the Small Business Administration on May the 5th. This new IFR was issued on the PPP loan program, and we keep getting these, though we still don't have anything on forgiveness. The one we're all waiting on hasn't shown yet. But what this one does, it deals with a couple of special cases. Normally, loans from the SBA go to businesses that are fully subject to all of the anti-discrimination rules. However, not-for-profits are now in this mix. And some of them, especially religious ones, are subject to special federal rules that exempt them from federal requirements for discrimination rules. And what they've now done is the Small Business Administration has provided that those not-for-profit organizations that have exemptions from non-discrimination rules at the federal level can still qualify for a PPP loan. They do not have to meet the general criteria of not violating the non-discrimination laws in order to be able to get the loan. Also, the document clarifies that student workers generally count in the PPP loan program. However, if they are a work-study program worker, which is considered more of an educational issue, then those work-study program workers do not count. So if you have a university or some other educational institution that's involved and has a PPP loan, and you're looking at these student workers, you probably want to take a look at this particular interim final regulation. Continue on to the FAQ again. On May 3rd, they put a second one up that day. This is more of the FAQs for the Payroll Protection Program, posted on May the 3rd, second one that day. What they had done, they had issued new seasonal borrower rules, right, that said a seasonal borrower now has more than, they essentially could pick, as we talked about last week, a whole breadth of extra time periods to do their testing for their maximum loans. Not terribly useful for a lot of them because they already filed for their loans, but we got this. But they hit a problem. The application that they have only lists the old time periods. And one of the things you certify in the loan application is that all your information provided and all the attachments are true, complete, in line with the instructions and the form. And it also tells you that if that's not the case and you certify this, we could throw you in jail and fine you huge amounts of money. Obviously, some people got a little concerned because these new methods that we were told we could use are not on this document that we're signing, and we're signing a document saying that we're doing everything according to these rules. So the question became, what about that statement? Can we really use that application in order to file, in order to take advantage of those special periods for the seasonal employer? Well, the SBA did not want to go put up a brand new form. So what they've now said is disregard. I love that. Disregard those instructions about seasonal employers and the periods they can use, and go ahead and use what is in the interim final rule. And you can use that. There'll be no problem. You can go ahead and apply. We're not going to worry about you, right? This same addition to the FAQ, they also discussed the special situation of hospitals exempt from tax under Section 115. Generally, a hospital under the control of a government, local government, state or local government, is exempt from taxes under Section 115. Now, governments don't qualify for PPP loans, but not-for-profit organizations who are 501c3s do. In many cases, these government hospitals could have qualified also as 501c3 organizations. They've never applied for that because, they didn't need it, right? They already had their exemption. What are you going to do with 2 exemptions? So they were okay with that. Now, though, the question is, because they don't have the 501c3 status officially, they have no letter from the IRS saying they are one, can they get a PPP loan? The SBA has ruled, as long as the hospital appears they could be a 501c3, with one particular exception for one rule, as long as they appear they could meet the requirements they're described in 501c3, they can still qualify for a PPP loan if they meet the other requirements. So they gave some relief to those hospitals. Now here's the one that comes the Turn in Your Employees version. This was the first edition on May 3rd. And this is, again, the Payroll Protection Program loans, frequently asked questions, by the SBA on May the 3rd. This problem a lot of companies are running into. Okay, when the shutdown hit, their business was shut down. When they were shut down, they laid off their employees. These employees go and apply for unemployment. Now, let's say today, they get their PPP loan amount. It's funded in the bank. We're ready to go. They call the employees up and they say, well, I'm ready to pay you. I'm going to rehire you. So I'll rehire you and we'll start your paycheck today and we'll pay you for the next 8 weeks at the same rates and everything. And I don't care if you're working or not. We're fine. But we're going to pay you. And the employee says, well, there's a problem I've got here. It turns out that because of that $600 addition to the amount they would have gotten as unemployment, what they are getting per week is more than they were being paid by the company when they were working. And they're saying, well, let's see. I can be paid nothing. I can be paid this higher number for doing nothing, and you're going to pay me, but you may want me to do something at some point during those 8 weeks. You might even want me to come in, and maybe I don't want to be there because I don't want to be exposed to the virus, so I don't really want to show up. So I don't think so. I don't think I want to stay on unemployment. I'm not going to come back to work. Now, the way unemployment works is generally you're not allowed to turn down a job offer, and it would seem especially would be true if the job offer didn't require you to do anything. That would seem like a really difficult time to get it done. But the problem is, of course, the employer cannot meet the requirement now to have paid 75% of the first quarter's wages, or the prior quarter. Normally the first quarter, well, I guess at this point in time, be the second quarter's wages. We aren't going to pay 75% of those wages to the employee in this quarter. So we have a problem now. We can't meet that, so our loan reduction is going to be reduced. Even if we go out and get other employees, remember, we still have the 75% test seems to be linked directly to the specific employee. And this employee will get nothing, meaning we're going to lose forgiveness equal to the entire 75% of what they were paid the last quarter. That would be bad. So what the law does is it says we're not going to penalize you, employer, in this situation if you do 2 things. First thing is you have to make a written offer to the employee to hire them at their original rate of pay and to give them the same hours they had before. So you're offering them their old position back. Again, nothing says they have to work. And in fact, as you look at the employee retention credit, you notice that even only counts for larger employers if they're not working. Don't need to work. We're going to pay you. But after you give them the written offer, they say no way, you document that they have refused to return to work. It appears, and again, we don't have the forgiveness documents yet, so that's still a big problem, and it's kind of a broken record, but there's not much I can say. We don't have them yet. We're probably, though, going to have to provide that documentation of the written offer and the refusal to work as part of our process of getting forgiveness to show that we can meet this requirement. Should be fairly obvious that those documents will then eventually end up in the hands of the state unemployment agency. And the state unemployment agency is almost certainly going to be told by the federal government that we're not paying you. We're not paying for that person after this time. The feds are funding this. So that's going to put a huge pressure on the state to go out there and get the money back from that employee. Obviously, that's going to cause some issues. Now, the question is, though, is an employer going to be willing to do this? And I guess one thing to consider is, how do we get in this situation? Well, realistically, the original proposal for this program would have been that, yeah, the PPP restores your payroll, right? The unemployment would have been set at 100% of what you make. But if you think about it, unemployment doesn't pay any fringe benefits. Your job may very well have some fringe benefits. So the idea was you would be no worse off going back to the employer. In fact, you would essentially take 8 weeks out of the pool of maximum unemployment you could get. So in case, your employer never recovers, you at least, will still have your full benefits there. And the other flip side of it, though, is that you also probably get at least some employee benefits that you wouldn't get if you were unemployed. So all is well and wonderful. That would have worked fine. Except the states told Congress that a lot of states said our unemployment systems cannot handle trying to set a 100% of compensation number. And they're saying, but aren't you told? Yeah, I know we've been told that, but we can't handle it. So there's no way it could be done. We can't do that. Best we could do with our systems and personnel, and the staffing we have, would be to add a flat amount to everybody's unemployment. The average shortfall between unemployment and what a person gets on what a person earns, what they were earning before they filed for unemployment, and what the maximum they're going to get from the unemployment is $600. So Congress decided, well, we'll just do the average number, right? That'll work. Not understanding that adding the average means that a huge chunk of the employees are going to be getting more than they would have gotten. Because again, the average number is 600 short. That means there are definitely ones that aren't 600 short. The second problem is the median wage paid to an employee is almost certainly less than the average, which means not only is it, we're going to have some that are paid, but more than half of the employees most likely will make more on unemployment than they would make if they came back to work. That makes it very difficult. That's how we got there. Now, again, the issue is some of your clients will hear that and say, but I don't want to do that. And it's like, well, you do that or you lose the forgiveness. And it's like, yeah, there's no other solution. The answer is no, not really. It actually hurts you more than you think. Because remember, you're going to have a loss of FTE probably. You're going to have, you're not going to have the money there. You can't pay that employee. So you don't get the forgiveness. So you lose that part on that part of the loan. But you also lose again because you get dinged a second time because you dropped that employee's wages by more than 25%. Or, basically they didn't get 75% of the last quarter. And because of that, we reduce we reduce your cancellation by that shortfall, which is the whole 75%. So it's actually worse than just losing the ability to pay that employee and offset that. It's not just give that money back. You're going to lose the forgiveness for some of the money you used that you actually used to pay people who came back. So yeah, it's a big problem. That's the reason why that May 14th date is so important. Some people may be much better off if they don't want to go this route. And then remember, they still probably got to go hire somebody else because they've got to get enough money paid out in order to be able to, show they spent all the funds. So, or I guess you could just send the money back. It doesn't matter either way, but you understand where we go. But if you actually get it paid, that gives you more money to pay the rent, utilities, and things like that. Because we have that issue that at least three quarters of the forgiveness has to be used for payroll. So that means if I get less payroll, I'm going to automatically have less rent and other items that I can pay with the rest of the funds. So yeah, it's an interesting problem. And this really does not totally solve it, but you understand it wouldn't surprise me this is the way we went. Finally, we can move off of COVID-19 relief issues for a second here. The IRS released the long-awaited regulations. This is Reg Project 113295-18, issued on May the 7th. These regulations relate to excess deductions on termination when a trust or estate terminates. As you may recall, Section 642H provides in the final year of a trust or estate income tax year, if there are deductions in excess of income, right, other than things that go into an NOL or things that are like, carryover capital losses, other than those things, if there are losses in excess of income, then those pass out to the beneficiaries, the residual beneficiaries, in the final year of the trust or estate. But traditionally, we had always treated these in the regulations under 642H, they had always been treated as miscellaneous itemized deductions. And the problem became the Tax Cuts and Jobs Act added Section 67G, and 67G tells us that we get individually no deduction for miscellaneous itemized deductions during the period this law is in place. So until they pull it out, remember we have the reversal for the individual provisions in a few years here, but until that happens, we would get no deduction if these are miscellaneous itemized. Well, a lot of people were thinking, no, that's not right because Congress did not pull 642H, so it should still do something. And, there's got to be some way we can get deduction. Well, the IRS noticed this, and back in 2018, they asked for guidance in Notice 2018-61, asking, is there some way we can fix this? And what we discovered was that, they got the responses back, but last year we went past the original filing date for trusts. Therefore, on April 15th, we had no guidance. We went past the extended filing date of September 30th. Still no guidance. So last year you had to try something. Some people took no deduction. Some people treated it as a miscellaneous itemized deductions not subject to percent. And the problem with doing that, though, was the 1040 instructions told you there were only a few things go on that line. It told you absolutely nothing else would go there, and this wasn't one of them. And by the way, we're going to discover in the proposed regs it won't go there anyway. But still, so we're kind of stuck. We thought we could get it, and the interesting part is the K1 instructions implied you could take it, but the instructions to 1040 Schedule A said no. Well, we did finally get an answer, and the IRS has decided to abandon the old regulation. They decided there is no reason why those deductions do not retain their nature when they leave the trust, but that's their nature on the trust return. And what they have decided is that when you have excess deductions on termination, you will have to divide them into three categories. Category 1 will be those items deductible in computing adjusted gross income. For most trusts and estates, anything except for state income taxes and probably real property taxes on property that's not rented will probably end up in this category. And the IRS has a very clear example in the proposed regs that the beneficiary will take this deduction in computing AGI, which means most likely it ends up on Schedule E in the trust and estate section as a negative number. Okay, that's what we usually see, but that'll be what'll be there. And so we get it in computing AGI. Now that's interesting because in the past, while we still could get the deduction on Schedule A, the catch was that those deductions, miscellaneous deductions, didn't count for AMT purposes, and you still had to itemize. So, and you had to clear 2%, in order to be miscellaneous. So it's interesting, the IRS is saying this is new, and I have a feeling if you try to then go back and amend an old return to get back minimum tax, don't be surprised. I do not think they're going to let you do that one, right? But they will let you handle this for 18 and 19. It clearly is for years after 17 it applies. And that does mean that 18 return you filed last year, if you didn't take the deduction, perhaps you didn't take it because you read Schedule A instructions, said, well, we can't take it. Maybe you didn't take it because you didn't have enough to itemize. If you didn't take it, then now you have an amendment possibility to get a refund. Secondly, if you did take it and you put it on Schedule A, probably now it should have been on the AGI, and that could make a difference in various scenarios. So you might have an amendment there. We're also going to need to have some guidance because the K1s have to give us all this detail for how they are. Now, the other two categories the excess deductions can fall into, and really for practical purposes, it's only going to be one, but we'll call it the two. They mentioned other itemized deductions, right, that are not 2%ers, not miscellaneous. And the third category would be miscellaneous itemized deductions, subject to 2%. Now, at this point, you shouldn't get anything in Category 3 because the trust itself will block that deduction. So it can't be an excess deduction on termination if the trust doesn't allow it. That's in there to take effect when we get past the end of this in 2025, if I remember my numbers right. When we get past the end of this, that will allow this to function once we get back to basically miscellaneous itemized deductions under the theory that the TCJA is not extended on the individual side, which we'll see what happens, but that's where it goes. Now, the other interesting aside in here is they have detailed guidance in there telling you about how you're going to determine which deductions survive. They borrow the same method we use for determining what's the nature of income when computing DNI. You're just going to go the other direction now. So as the law provides, you take your expenses. You first take any expense that's directly connected to an item of income, offsets, is used up against that item of income first. Then any deductions that are either not assigned to an item of income or deductions in excess of the income they're related to, those can be assigned against any particular item of income. And as I would read it, I should be able to take, let's say, a bad expense like state income taxes, and I should be able to absorb that expense against some other, against the income items to get rid of it, to try to maximize, if I can, the deductions available in computing AGI where the heir or the beneficiary will not need to itemize. The example they give us in the regulation has two big problems as far as I can see. If you read that final example, and it's in the article that we wrote to write this up, if you download the PDF, you'll get it. If you take a look at the example, they have that we have like $2,000 of rental income. Okay, good. And we have $3,500 worth of real estate taxes associated with that rental. Now, there's a problem right away. They say it's an itemized deduction for the real estate taxes associated with the rental. Well, that's a problem because it's not. Section 67E tells us that a trust computes its income in the same way as an individual, except they get some additional deductions in computing AGI. But they also get every deduction in computing AGI that an individual gets. An individual under Section 62A4 is allowed to take above the line in computing AGI any expenses incurred in the process of a rental, right? Renting under 212, as well as taxes related to the 212 activity. The real estate tax, come on, you put those on Schedule E, right? They go there, they go above the line. So first thing is it should be an itemized deduction. But then there's another problem. So what they say is we offset the rental, we end up with $1,500 of this itemized deductions left over, and then we ended up with, $11,000 worth of otherwise 67E expenses. And they, of course, offset the 67E expenses against the other income. They don't touch the real estate taxes. Well, that would be allowed, but it'd be crazy to do. It makes a whole lot more sense to take the real estate taxes, let's assume we do have tainted taxes, and we've got more than enough other income with interest, dividends, etc., to go ahead and put it up there against that income and leave the $11,000 of deductions, at least to the extent they exceed the amount of income, leave those alone so that what we pass out is entirely the amounts can be deducted above the line. So it's a real weird example, and like I said, I think it's wrong on the one count, and I think it is one that you'd never follow on the second issue, because you're going to want to try to normally maximize those items deductible in computing AGI. Next up, we talked about the letter from the gang of three, from Senator Grassley, Representative Neal, and Senator Wyden. They wrote another letter to the Treasury Secretary. Remember last week we told you in Notice 2020-32, and this is a letter from Treasury Secretary to Treasury Secretary Mnuchin from Senator Chuck Grassley, Representative Richard Neal, and Senator Ron Wyden on Notice 2020-32. And as we told you last week, IRS had ruled any expenses you pay that you use to get cancellation of debt, to cancel the debt on the PPP loan, that those will not be allowed a deduction. Even though CARES Section 1106I said that the forgiveness was not taxable, IRS said they never said the deduction was allowed, and they came up with, reviewing old cases, they came up with their justification saying that Section 265, which bars deductions that are related to income that is exempt from tax, that bars these deductions. Now, the senators were not the senators and representative were not happy. This also kind of came to a head because earlier this week, on the 4th of May, Secretary Mnuchin appeared on Fox News, and as part of the interview, he was asked about, well, what about this no deduction for these expenses? You know, is that correct? I mean, a lot of people are complaining that it's not a correct interpretation, it's not what Congress meant, and you shouldn't follow that. Secretary Mnuchin said, no, you can't double dip. If the money that you got to pay this stuff is non-taxable, you can't take a deduction. That would be double dipping. And then he went on to say that is basic tax 101. Something tells me that, you know, the people, including the Senator Grassley, Representative Neal, and Senator Wyden, who had been complaining about the ruling, did not take kindly to being told that this is tax 101, which essentially is saying indirectly that any idiot with a modicum of tax knowledge should have been able to figure out this wasn't deductible. Which also means that if the Congress wanted it to be deductible, any idiot with a modicum of tax knowledge should have been able to figure out that you needed to say that in the law, and you guys didn't. Tough luck. Remember, they even kind of emphasized that in the notice, that it didn't say it was deductible. Well, the three did not take to this well, and while officially it's a polite letter, there's an edge to this letter when you start reading their paragraphs about why they shouldn't have done this and how the IRS got the analysis wrong. This has a lot more edge than that letter they sent about the health care and the workers and the employee retention credit. So what they say first is, look guys, why in the world would we have put CARES Section 1106I in the law if we didn't intend for people to be able to deduct the expenses paid? They said, look, had we not put it in there, when the debt was canceled, that would have been income to the taxpayer. Now, that income would have all been represented by amounts that are deductible on the tax return, so the net effect would have been zero. So if that would have been zero, there's no point in us saying it's not taxable, because even though it was taxable, you get deductions to fully offset it, you have net zero. They're saying if we follow your theory, even though we put that in the law, we didn't change the taxable income $1 on the return. They said that's clearly not our intent. We did not put a provision in the law that has no effect, and interpreting the law in a way where this has no effect is wrong. That was their viewpoint. Then they went on to say, oh, and by the way, that analysis you have of 265 and those cases you cite, it is fatally flawed. You didn't get it right. And one of the key reasons you didn't get it right is every case you cite specifically at some point says, obviously Congress did not intend for you to be paid this money tax-free and then to be able to claim a deduction for those items. And they said every one of them referenced congressional intent. It is absolutely clear Congress did not intend, for the reasons already mentioned, for those things not to be deductible. You should have taken congressional intent into account because all of your cases did. And if you did that, you would have come to the conclusion that those items are deductible. Now, they of course call for a change in position, but with the Treasury Secretary kind of staking out his position, and IRS has sent a letter back to the senators saying, well, thank you for your letter, polite, and we certainly will consider your position. But they didn't say, like they did a letter at virtually the same time for the health care, that we are going to modify the guidance. So this could come down to whether Congress will pass the law change. Now, Senator Grassley and Representative Neal, who are chairs of the tax writing committee in each of the respective chambers, have both said that they are going to work on legislation. We already have legislation introduced in the Senate, that is already going that way, introduced by members of the Senate Finance Committee. We'll see if they all agree and pass it. But certainly it's going to be interesting to see if the IRS backs down on this one or if they do force a law change to go through. Okay, another not COVID case, right? This is a cannabis case, Richmond Patients Group versus Commissioner, TC Memo 2020-52. This is on April the 4th, 2020. Now, this is a case because it illustrates something really important for cannabis businesses. Everybody should be aware in Section 280 Cap E, if you are dealing in drugs, and that's how the feds view this, illegally dealing in drugs, you are barred from claiming any business deductions in your business except for cost of sales. Now, this was a cannabis business that was looking, the only deductible item is cost of sales. If you look at the regulations under 471, you're going to discover that if you are a reseller, all you're going to get is the cost of buying the product and transportation. That's basically it, the freight. The freight and the cost of buying the product. But if you are a manufacturer, you're going to go to full absorption costing rules, and you're going to find that we deduct a whole bunch of additional costs. Now, this particular taxpayer decided that because even though they bought the plants, everything was dry, basically was there, was pretty much ready to go, what they would do is put them in packages and do some minor other things. They decided, hey, wait, we're a producer because those little things we're doing. And because of that, we're going to go to the fuller absorption side, which allows you to pick up a portion of the officer's work, a good chunk of the work of other employees. We can pick up a lot of expenses, a portion of almost every indirect cost that relates to this. So we can get some electricity, we can get some rent, we can get other things into cost of sales. The problem they had was the tax court said, guys, no, you're not a producer. You're doing very, very minor things. You're a reseller. And even though you buy product from some of your customers, they're not really working for you or doing this as a direct contract to you. You're not the producer. Because you're not the producer, you actually did less than the prior litigant we had earlier this year, who came to court and lost. You're doing even less than them. You are not a producer. If you are dealing with cannabis businesses, it's really important to understand the distinction between what's a producer and what's a reseller. And you'll notice that the IRS in court has exclusively gone against resellers or people who may have claimed they were a producer, but the IRS position was going to be immediately they're a reseller, because for resellers, there really is not much they can deduct. Producers can get a whole lot more in as a deduction. So if you're growing the product, right, producing the product, then you're in much better shape. 280 Cap E is not good maybe for you, but it's not nearly as bad as if you're the reseller. So if you're in the business, you should be involved. If you deal with clients in that business, you need to be involved and understand this case, why Richmond Patients Group's lost, and how far you need to go to be a producer, because that's crucial. We've had a number of cases recently where they've tried to be a producer and they've been shot down. Okay, hey, one more thing for the IRS to come up with here. We have a guide on the Economic Impact Payment Information Center on the IRS website posted on May the 6th. The Treasury Secretary had said We discovered early on the IRS was sending checks and making direct deposits into the accounts of deceased individuals. The Treasury Secretary had said again on TV that, oh, no, that was wrong. Those people need to send the checks back. The IRS had never told us how to do it, and they hadn't actually issued guidance saying that. All we had was a Treasury Secretary. And we didn't know, okay, who has to send it back? Does anybody who's deceased have to send it back? What if somebody died in 2020? Do they have to send? Do we still have to send it back even though they're alive? And on paper, it appears they should get the credit this year, because nothing in the credit said you had to be alive to get the credit. Well, the IRS came down with what we might call a rather harsh way of doing this. Anybody who died, if the person died before the payment was received, it must be returned. So let's take an example. Mary, let's say, got her check on May the 3rd. Mary dies May the 4th. Mary's estate, and Mary may have been in the hospital in a coma on May the 3rd, but Mary was alive on May the 3rd when the payment came in. Mary's estate will keep that money. Now, had the check been delayed 2 days and come in the day after Mary died, now we have to return it. I'm not really sure the law agrees with this view. The law talks about you get this credit in 2020. It just talks about if you're single, it's $1,200, married, $2,400. We get the rules for adding in the kids, right? We have those particular rules and the phase outs, but nothing said you needed to be alive at the end of the year. The only way I can see they're going to try this is to stretch the idea that estates don't get it. But again, an estate's not getting it on a married filing joint return. It's a joint return, the surviving spouse's return, and that's who got the check. Now, we're told in that case, surviving spouse is supposed to send back their $1,200 that related to the deceased spouse, or whatever proportionate share if we're in the phase-out range. Still not clear. And also, the interesting part was for 2019, for the advance payment, we were told for 2019, we were to compute that as if it was a payment made in 19, and we were to use the information, we're to use as if the law applied to 19. Well, in that case, they were alive in 19. The law applied. And again, why wouldn't they get the check? Nothing said they had to be alive at the date they received the check. Now, 18, I think if I read the law with 18, I'm a little less sure if they're using 18 numbers that works, especially if they died in 18. I think that one, maybe you can argue the 18 checks should go back. But the 19 and 20 checks, I'm not sure the IRS is correct on this. I think there's real question as to how correct they are, but they definitely are taking the position they're supposed to send the check back. They also said for a resident alien, you must qualify in 2020. If you don't qualify in 2020, then you have to send the check back. Again, many commentators are saying there's nothing in the law that said you had to qualify in 2020. Yeah, you're a non-resident alien. You don't get a credit in 2020, but we reduce your credit not below zero. Just as if you won the lottery in 2020, and previous years you'd had AGI of $12,000, this year you have $40 million, you're not going to get the credit this year. You don't qualify for the credit in 20, but you don't have to return that 19 credit just because in 20 you're going to blow it away with the lottery winnings. That's an issue. And a same issue comes up for incarcerated individuals. And again, saying if you're incarcerated, then you have to return the money. Now, my take on this one is that that's just embarrassing, right? So they didn't do that. And probably the resident alien is a bit embarrassing too, because, we're paying somebody who's no longer in the U.S. and, that's supposed to be an incentive to keep the U.S. economy going. I understand that, but the problem is you wrote, the law was written. And what Congress passes is what matters far more than maybe what they thought they were passing, or maybe what, after they thought for a while and they see what people are saying, about what's happening, they're saying, oh, no, we should have changed that. Yeah, that's just bad. So again, I'm not sure I like any of this on the checks for deceased individuals, but I also know deceased individuals, resident aliens, and incarcerated individuals, but I also know that it's probably not going to be worth your money to fight it. If you want to return the check, the details are there in the FAQ, or in this particular payment, which has FAQs, this particular page. We also have those addresses and information in the materials. If you download the PDF, you'll get them. So if you're going to do that, we'll show you how to return the check, how it works, and you can take care of all that. And my guess is most people, even though maybe it shouldn't work this way, most people will send it in. And then if in fact somebody wins in a challenge and decides to challenge just because, hey, I want to challenge it, even though the money no way justifies going after this challenge from the expense of going to court, and they win, then you'll get your refund request, etc. But that's about how it goes. Hey, we've actually got CPE running now. Now, again, not in live classrooms yet. I've not done any live classrooms. I've been doing them, though, online. So we've had lots of things going on. I've done sessions, and we've done some hour discussions. We've done some issues, Phoenix Tax Workshop. But now we're actually doing full 8-hour CPE programs. I have done 2 of these already, and we'll do it. Now, the session I did for New Jersey this past week, they will rebroadcast it on the 14th and 15th of May. So you can still sign up. It'll be a, one of those live where we will answer questions that you have, but it'll be a straight rebroadcast of what we had last week. So it's a straight rebroadcast. That does mean that, yeah, there probably will be some law changes in the interim, and I will try to record some sort of video that won't count for credit, but can be used to say, okay, based from that course, here's the big things that have changed, and try to get you up to speed. So we'll kind of do that. If you've been listening to this, you probably are up to speed as to what's been added as we get the stuff new, and by next week you listen to this, next week you'd be up to speed. But I hope to get something in there, just in case, and especially if anything big happens, like the SBA actually puts out the guidance for repayment. That would be really nice to have happen. I'll try to get that recorded. But if you missed the original broadcast, you want to sit in on it. We had it. I mean, it worked well, and it was done. It really was well. The session went well. We got a lot of questions answered, and you want to present your questions. You can go there on the 14th and 15th. Sign up. New Jersey, again, this time is selling those as 2 separate sessions. The first day is primarily the business things that are COVID-19 related. Day 2 is the individual issues, and then also the Secure Act is on day 2. So day 2 are individual, Secure Act for the most part. Day 1 is going to be business. There is some business information on day 2 because when we did it, recently, and actually it's going to be 2 weeks ago at this point. When we did originally, between the first day and the second day, we had information released. So there are some updates at the beginning of the 15th course that update what's in the 14th. So if you take them both as an 8-hour session, you'll get all that. If not, then yeah, there's a little bit at the beginning of the next day that is important, and that also includes the thing about you can't deduct the amounts paid for the loan per the IRS that you paid that forgave the loan per the IRS. And that may not hold anyway, we see now. We're also going to be doing an Idaho session. This will be a live, not a rebroadcast, on May 19th and 20th. In this case, they are selling it as a single 8-hour package, but it'll go over 2 days in the morning, so we'll have 2 morning sessions. It again will be, though, broken into 2 4-hour sessions. It won't have the hard divide between business and individual because since everybody's going to be there for both days, we're just going to kind of go naturally and run the flow for the 8 hours like it's an 8-hour course. And wherever we cut off on the 19th, we then pick up on the 20th. And who knows, there'll probably be law changes between the 2 days too. So we may still have some review after we finish that. Finally, I've got another 8-hour course coming in May on the 27th. This will be for the State of Washington Society, so the Washington Society of CPAs, webcast on May the 27th. This again will be a single 8-hour session. If you can make any of these sessions, we look forward to seeing you there. We will have some traditional sessions for other topics that will start in June. I'll be doing sessions for Arizona. I'll be doing sessions for New Jersey. I'll be doing sessions for Oregon in the month. And I'll also be doing this particular session for Illinois CPAs. So if you're in Illinois, I will be doing this then. And at that point, hopefully you have enough breathing room that, it doesn't keep changing every 2 days. So we'll see how that goes. But that will come in June. We'll do that for Illinois Society. So again, been this week in current developments here. Remember, you can catch our regular updates at currentfederaltaxdevelopments.com online. We also say questions and comments to Ed Zollers at currentfederaltaxdevelopments.com. You can follow me on Twitter. I'm at Ed Zollers. I do follow discussions on the subreddit /r/taxpros. I also follow Connect sites for the states of Arizona, New Jersey. I've added Illinois, and also do it for Minnesota. And I try to participate in discussions there if I see something of interest going on in those locations. So if you're a member of there, you can check it with those sites. I also follow the Tax Talk site that's run by a Cal CPA group. That is open to any CPA anywhere in the country. So if you can't want to, you can sign up there. The Reddit site is also open to anybody, but it is moderated in the sense that they will throw things out of there if it's just somebody looking for free, some person that's doing TurboTax and looking for free advice. Yeah, they're not going to get far there. So those are places. They're really useful places, especially if you are a sole practitioner or in a small firm and you just want to bounce an idea off somebody. Really great places to go. So I suggest take a look at that. Hopefully we will get the guidance on the forgiveness. So we can talk about that in next week's session because the 8 weeks are running. And just in case this gets to anybody who can control that in SBA, Treasury, or in the Senate, we'll take it. We do need that information. Hopefully we'll get that. And we will see you here a week from now. We'll talk about more current federal tax developments.